But first, after last week's market whiplash, investor sentiment towards the economic outlook remains close to max bearishness, according to Bank of America's latest global fund manager survey. And I can't say this one, guys, is too optimistic on the markets. If you look at right there, investors are just not really expecting much economic improvement. Really, I would say flies in the face out of what we learned yesterday from every CEO that came onto the Yahoo Finance All Market Summit. I think right back to a Target CEO, Brian Cornell, told me, he said the holiday season is going to be pretty good. But at least when it comes to this survey, at this point in time, not so great.
Well, but not so great is good. Mm-hmm. Not so great is good,
for the markets.
For the markets.
For the markets.
Yes, exactly. I mean, as Michael Hartnett, the strategist there, writes, the fund manager survey screams macro capitulation, investor capitulation, and crucially start of policy capitulation. Mm-hmm. And capitulation is what market strategists look for to signal that things can go up. Now, things have already started to go up, right? So maybe this is a little bit of a backward-looking signal. But when he says crucially the start of policy capitulation, he's talking in particular about the outlook for rates. And are people giving up on the outlook for rates to actually be cut? And he says, yes, that is what seems to be happening. So that, he says, is maybe a good thing for the markets.
Well, and price in as well here, at least some of the fund managers are, into their portfolio where they can actually have some type of appetite for risk. And it seems like the appetite for risk, yeah, it's at one of the lowest levels since 2008, 2009 right now. According to this survey, 56% of some of the fund managers surveyed and the investors say that they are currently taking lower than normal risk levels. That is down month over month from last month's record. And so with all of this in mind, you think about some of the different sectors that could be the most susceptible to this and that risk that is also being evaluated. Tech in a rising rate environment. You're looking at some of the consumer discretionary names if households were to pull back on their own kind of discretionary spending. And that's exactly where it could have this much more longer protracted hit on the appetite for investors to actually poke at some of the tech names, despite the rally that we've seen over the past 2 days here too.
Yeah, this is always my favorite survey on Wall Street. It's just a really nice snapshot into what institutional investors are thinking at this moment. I'm looking at another chart I tweeted out this morning with the term Happy Tuesday, and it shows market liquidity is deteriorating fast, worst since April 2020. You can see market liquidity falling off a map in large part because of what the Federal Reserve is doing and, of course, what other central banks are doing overseas. And when you see that chart, I really do think that explains why, to your point, Barry, we're seeing just continued weakness in tech stocks. Tech stocks have really benefited before the sell-off from rampant liquidity, and now we're seeing it go the other way.